The new century finds American finance once again on the brink. The stock market has seen an extended downturn, and the San Francisco earthquake is bankrupting insurance companies both in the US and abroad. On Wall Street, the first 9 months of 1907 sees stock averages drop nearly 25%. Then, in October, comes a run on New York's third largest banking trust, the Knickerbocker Trust Company.
They had about $5 or $6 million in reserves. That money is largely gone by about lunchtime.
Desperate Knickerbocker officers approached New York's most influential banker, J.P. Morgan, with a plea for help.
J.P. Morgan was not by any means the richest man in America, but he was one of the most powerful.
As rich as Morgan was, he doesn't have enough money to backstop the entire banking system. The size of the banking system by 1907 is billions of dollars, which means on any given day, it's clearing millions and millions of dollars. Morgan just didn't have that kind of money.
Over the course of the next 11 days, Morgan will use his influence and personal fortune to stop the bank runs, prevent a stock market crash, save the city of New York from bankruptcy, bail out an insolvent railroad, and basically rescue the U.S. economy.
During the Panic of 1907, J.P. Morgan brought together the bankers of New York City into his boardroom, reputedly, maybe mythologically, locked the door and made them figure out how to work together as a group. That required real leadership.
People at first are grateful to Morgan for preventing a collapse of the entire financial and economic system of the United States.
But then they realize, wait a minute, how can this guy be a hero? He's a banker.
Initially, J.P. Morgan was viewed as a hero. He had saved the economy. But over time, resentment grew. How come this guy had so much power? How come this guy could save the U.S. economy? Why was a banker in charge? Why do they have so much power? And indeed, J.P. Morgan in 1913 gets dragged in front of Congress and lambasted by congressmen and senators. You know, you guys are just parasites. What are you doing? In 1907, you caused that crisis. You didn't bail us out. They rewrote history.
And why shouldn't we rake him over the coals? He's J.P. Morgan. He's the guy that financed Edison. He started General Electric. He created U.S. Steel so we could build skyscrapers. He backed AT&T so we could call Mom Collect. Why should we trust a guy like this? No, we need to fix it so he can never bail us out again.
Well, maybe we can set up a Federal Reserve System that will reduce some of the risk in the financial system without having to topple the political deal of unit banking. So the Federal Reserve was created as a sort of half measure to reduce the risk of banking instability without dealing with the core problem, which was unit banking. And it didn't work. The Fed was a lender, but it was not a bailout agency. These banks were still undiversified unit banks. When agricultural prices fell a lot, the banks still failed.
The Federal Reserve was given the right to issue its own currency, and it discovered that it could create its own funds, and they could just write IOUs on themselves. Now, under the gold standard, there was a limit to how many IOUs on themselves they could write. Once the gold standard was lifted, we were off to the races. There was no constraint anymore on the Fed's ability to just create claims on itself because it never had to redeem those claims.
Now, for the first time in our history, for better or worse, America has a central bank with the authority to create its own money. Along with this currency-creating power comes the authority to supervise and regulate banks.
And it's supposed to create stability in the banking industry forever. It's supposed to eliminate all these banking crises that happened in the 19th century. And what happens? 15 years later, we have the biggest financial crisis in American history.
Loan sharks, they got half the guys at the plant on the hook.
If the 19th century was about discovery and invention, the 20th is all about taking those advancements and turning them into products for sale.
There are tremendous changes in technology, things like the radio, phonographs, automobiles. So you've got all these new appliances, all these new things that are exploding out there.
The great demand for consumer credit in the United States really takes off at the beginning of the 20th century as we get movement into the cities, people leaving the farms and moving to the cities, immigrants coming to the cities, and having to deal for the first time with cyclical unemployment and those sorts of things creates a demand for consumer credit.
Banks can't afford to provide these somewhat risky consumer loans because state usury laws limit the interest rates they can charge. As a result, banks lend money for the most part only to rich people, who are considered low risk. Everybody else has to get their credit direct from the retailers, at much higher interest rates. Or if you need cash, the options are not only limited, they're scary.
Legal lending, above ground lending to middle class and low income people was almost impossible. So what happened? Loan sharks proliferated. We saw in 1911, for instance, it's estimated 35% of New York City's city employees owed money to loan sharks. And so what we saw in the 20s was an opening up of credit markets to basically allow people to borrow at higher prices but not get their legs broken.
An enticing combination of easy credit and a how high is up attitude sends America on a credit buying spree.
In the fall of 1929, the party is over. Corporate profits start to fall. As the stock market changes direction, banks call in margin loans. Cut short speculators can't get new loans. Fear is contagious and takes hold.
People started pulling money out of banks. Banks no longer had money to lend. People are stuffing money under their mattresses. The money supply is shrinking.
And although the newly formed Federal Reserve has the power to raise or lower interest rates at key moments in the crisis, it does neither. Until it's too late. And then it makes the wrong choice.
The Fed allowed the money supply to drop by like 30%, 33% between 1929 and 1933. And this deflation creates huge amounts of problems for anybody who's borrowing money.
As depositors became suspicious of the solvency of banks and they started to take their money out, the banks sort of one by one failed.
The Federal Reserve did not act as an appropriate lender of last resort. It did not flood the money markets with liquidity, i.e. extra money. It let banks fail. And the economy shrunk by 33%. The money supply collapsed by 33%, and unemployment rose to 25%.
The years between 1929 and 1933 see more than 10,000 bank failures in the United States, nearly 5,000 in 1933 alone. What had happened was what the financial sector likes to call a correction, and quite a big one at that, although previous panics hadn't been nearly as devastating.
Could have been a fairly mild contraction or an ordinary contraction, a correction of the overinvestment boom. But then on top of that, we got the monetary contraction, which didn't help. And on top of that, we got a whole raft of government policies which impeded recovery, starting with Hoover and continuing with Roosevelt.
Practices of the unscrupulous money changers stand indicted in the court of public opinion.
And so we get major reforms in 1933 and 1935. And guess what the 1933 reform is most intent on preserving? Unit banking.
The Banking Act of 1933 is more commonly known as the Glass-Steagall Act, after its congressional sponsors, Senator Carter Glass of Virginia and Representative Henry B. Steagall of Alabama.
So one of the things that Glass-Steagall did was to say, okay, you're either in the banking business, which means that you take in deposits and you make loans of a certain type, and that's it, or you're an investment bank and you can do different, more risky things. And so that was a clear separation.
A second main provision of Glass-Steagall establishes the FDIC, a federal system of bank deposit insurance.
It was originally set up to insure small depositors, so the limit on the amount that was insured was relatively low. So the idea was that if your bank failed, there would be someone to insure your deposits and you would be compensated.
So you can just put your stuff in the bank and don't worry about it, and the bank will use it to make loans, but your holdings are safe, so don't worry about it. Jimmy Stewart is not gonna have to stand at the door and guard your money from evil Mr. Potter.
The Federal Deposit Insurance Corporation begins as an attempt to strengthen the small banks, especially the weak banks, who are being subject to runs during the 1930s. And the small bankers were all in favor of it because now their customers would no longer pull their money out and take it to the bigger bank in town.
The Roosevelt administration was opposed to the FDIC because smaller banks, the banks that were insured by the FDIC, would not exercise discipline because they would have this federal guarantee on their deposits, and their depositors would not impose discipline on them. It would be a great moral hazard.
A moral hazard is when you profit from risking somebody else's money at no risk to yourself.
For example, if a bank finds its ventures backed by a central bank or deposit insurance, that bank might choose to make riskier and riskier bets. Because if they win, it's a big payday. And if they lose, they don't actually lose.
You're subsidizing incompetent, risk-taking, unsound, insolvent banks.
The FDIC guarantees bank deposits. That sounds like a good idea, but what it actually does is incent banks to take a lot of risk.
And this is going to create a terrible moral hazard problem. But the small bankers had more votes in Congress.
In time, according to who you ask, either because of or in spite of banking regulations, America will recover from devastation to emerge as the world's most trusted capital market. It'll be nearly half a century before that perception is shot to hell.